Welcome to the Bulletproof Cashflow podcast, the go-to place to gain financial freedom through real estate investing. Here we interview investors, mentors, and entrepreneurs who share their secrets and advice to help you build passive income. Let's get into the show.
Hey guys, it's Augustino. Today's guest moved to the U.S. about 7 years ago. He got his start in real estate in 2011, buying a duplex for $45,000. Now, since then, he's been involved in large-scale commercial construction and real estate development projects worth well over $500 million. Today, he leads a syndication investing firm called Wildhorn Capital as his co-founder, and he personally controls over $40 million worth of real estate multifamily today. So he's done this with a mix of funds from investors domestically and internationally, and really people are looking to put their money to work here in the U.S. So without further ado, I'd like to welcome Reed Goosens to the show. Hey, Reed, thanks for coming on. I appreciate it.
G'day, mate. How's it going?
Good. So today, I'd like for us to explore the world of multifamily, especially as it relates to investing here in the States from other countries. I know you successfully closed millions of dollars in deals, and I'm going to guess there's many lessons to be learned.
There are many lessons.
Yes. So before we go on, if you like what Reed has to say throughout the interview, you can reach him on his website at reedgoosens.com or on Twitter, Facebook, and Instagram. His handle is Reed Goosens. You can also check out his podcast, Investing in the U.S., an Aussie's Guide to U.S. Real Estate. He has done some great interviews with some amazing guests, so definitely check that out. So, Reed, would you like to go ahead and fill in the listeners on how you got started in real estate?
Yeah, I'd love to. And by the way, thanks for having me on the show. You're doing an incredible job, so keep it up. But for all those listeners out there, as you can tell, my deep Southern accent, I'm from down past West Texas there, a little place called Australia, down under, where the kangaroos are and the wallabies are. But my start, I'm a qualified structural engineer, so I spent the better part of a decade working across the globe. And that's where in the introduction you mentioned I'd been involved in large-scale development of about $500 million worth of real estate infrastructure and retail ground-up construction. And one of the most notable things I was involved in back in 2008 was the construction of the 2012 Olympic Games in London. Nice. So I was in London. I finished university, went to London, had some fun in London, went to the south of France. I was gallivanting around the south of France on a super yacht working for the mega rich, and that's another story for another time over a beer. But when I returned to Australia in 2009, after having a great 2 years abroad, I really was a couple of years out of university, a couple of years of professional experience under my belt, and I was sitting at my civil engineering job and thinking, oh my gosh, like this can't be what I'm doing for the rest of my life. And in that moment, I realized I needed to my thought process was, how the hell can I get someone to pay me to go traveling and live around the world? And at that time, I'd met my now wife, who is American. She was my girlfriend at the time back in 2009. And we'd met actually in Europe. And I remember talking to her about this, this mindset. And I know you're hugely about mindset on this program, but I picked up the book Rich Dad, Poor Dad. And that really changed the game for me in terms of, I felt like I was this basketball player sitting on the sideline watching my life go by, and I wanted to take control of it, but I wasn't allowed into the game because, you got to get a job and you got to go do a career and you got to do this and you got to do that, and all these societal things that people tell us we have to do. And this book really sort of opened my eyes to the word entrepreneur, and I didn't really understand what it was. But then I sort of put two and two together, and I was like, wait, I'm a structural civil engineer working on these large scale development projects. And it's sort of those, when the blinkers come off and you think, oh my gosh, my clients are developers, are real estate investors. Like, oh, that's crazy. Like you start going to work with more enthusiasm because you're like, I want to learn what they do. And then from that, I started self-educating myself. And in 2011, 2012, I quit my job in Australia and moved halfway across the world. And I moved because my girlfriend, who's American, we wanted to live in New York City. And I didn't have a job. I didn't have anything. I just got up, packed left my well-paying civil engineering job in Australia and landed on the ground in New York City without a job. And I literally pounded the pavement until I found another job. And from there, I was at my first REIA event in New York City within 2 weeks of getting off the boat. And within 6 months, I'd purchased my first triplex in upstate New York for as you said, $45,000. So that's a little bit of a nutshell, the introduction of people may not know, but it goes to the fact that Australians have very much in our DNA, we're traveling a bunch. And if you've ever been backpacking, you'll know that Aussies are up there with like the number one people who travel. So I moved halfway across the world to pursue a dream and give it a crack, as I like to say.
Excellent. Yeah, I mean, and I think that's one of the deals that I see in my in our live events that we do here, is that's all about mindset. And I know that when their baseline is not set properly and they can't believe in themselves enough to really step out on the field and really perform, that's so those limiting beliefs that they get that really keeps them from living the life they truly deserve. It's and you just did that. You left your whole country just to come out here to build a whole new dream. And of course, be with your wife, but yes,
girlfriend at the time. We only got married actually a year ago, but it was to follow two loves, New York City and my girlfriend. So,
yes. So, but I know that one of the things that you really focus on, or at least early on in your career, anyway, in terms of real estate, is really getting money in from investors overseas and getting it into the States. Is that something you still focus on today? And
no, it is. And that's the story behind it is that when I first moved to the United States, I had a really hard time, just figuring out the American lingo for investing. Like I'd been in Australia learning about the Aussie way of doing it, and I was going to flip a house and do all the things in Aussie. And then I said, nah, screw it, I'm going to move to the United States. And I just packed up the bags and came. And then when I got here, I was in like New York City, the Big Apple, fast talking Americans, but like telling me about LLCs and cap rates and how do I get bank financing and this word called credit. And I had no idea what credit meant. And so when I first got here, there was just a lack of information around educating, particularly myself, like, because I'm fresh off the boat. I'm an international investor at that time. The banks didn't want to lend to me because I had none of this thing called credit, quote unquote. And I didn't know what credit was. And I soon realized that it was, it's a score that you get that judges you on how well you'll repay debt. And, I didn't know that, but I was very self-taught. And so the whole idea of my podcast and, what I do is educating the international folk about the benefits of investing here in the United States, because not only is the US very fertile for business in general, but compared to my home country and your home country, as well, Canada, Aussie and Canada, like the barriers to entry is so much higher than they are here in the United States. And when I first moved here and I saw that I could buy a property, a triplex for $45,000, like that's it, I was gobsmacked. And as Robert Kiyosaki said, like getting cash flow working for you. So again, the opportunities here were just so plentiful. And having that international perspective, I was like, I can see why international investors want to buy here and the fertile grounds that it is the United States to make it just so enticing for the international folk. And so that's where I started, the podcast and educating others about how you get your money into America, how do you set up your LLCs, how do you get your ITIN numbers, and how you register with the IRS, and all these different things about making sure you're legal to start investing here, because the United States is one of the few countries in the world that allow international investors to buy and own real estate. And Australia does as well, and so does Canada. But in the way that you can control an LLC to go out and buy and purchase a piece of real estate. And I'm sure we'll get into all those details in a minute.
Yes. Now, for locating these foreign investors, I mean, clearly you've already described why the U.S. is a great opportunity, but how do you go about finding them? How do you locate them and convince them that this is the place to be? How do you do it?
Yeah, well, so it's really through my podcast and through my thought leadership platform that in today's age, in 2018, you got to have education first. You got to educate people about what you do. And what I do is educate the international folk about the benefits of investing in. You put that information out there, you put that thought leadership platform out there, they will be attracted to you. And that's, it's sort of like putting many lines in the water for when you go fishing. Eventually something's going to bite. And the lines in this metaphor are content, digital assets like podcasts, like doing this podcast, like doing blogs, like writing books. Yeah. And you create a thought leadership and digital assets around this thought leadership, and that will eventually attract people to your lines in the water, and you'll snag some people. And from there, word of mouth grows and grows and grows, and that's how you create a business.
Yeah.
So that's really the intention, was to go out and as an education platform first and foremost, because I struggled with finding the right information when I first moved here. So it was really solving a problem in the beginning, and solving a problem for free. Like you can go listen to my podcast and read all my articles and blah blah blah. I'm not charging it. It's just like, I wish I had this resource when I first moved here, but I didn't. So that's why I created it.
Yeah. So I think part of the issue, though, is that you probably have to have them overcome some limiting beliefs, too, because I'm sure that many of these investors, they're like, even though you show them there is a way to do it and it's not that difficult, you still have to convince them in some way, right?
Right. And that's like, let's talk a little bit about the benefits of investing here in the United States. And we're going to talk about, like, I want to break it down into, I'm an engineer, so I always like to break it down to nuts and bolts.
Me too. Let's do it.
We've got the Western countries around the world, so Australia's, the Canada, Europe, those sort of countries where developed high level of high cost of living, barriers to entry into real estate markets can be quite high. So the United States offers a very good alternative for international investors to buy for cash flow. Because I know in Australia, and I know it's very similar in Canada, cash flow can be a little bit hard to come by in terms of commercial real estate. So the first reason is for those international investors living in those countries, maybe that they can't get into their own markets because the barrier of entry is too high. So they look at the United States as an alternative and they say, okay, hey, I want to place some capital, maybe it's my retirement fund or whatever, into international real estate markets like the United States. So that's the first type of investor I talk to. The second type of investor is the guys who are in developing countries like the Chinese, the Asian countries, India, South Africa, developing countries where they may have, the risk of their governments potentially taking their money away from them. So they want to place their capital into a stable market like the United States. So there's an influx of both types of capital, and actually more so from those developing countries because you have a stable US dollar, you have a stable geopolitical climate, regardless of your views on what's happening right now. In general, over the last 50 or 100 years, the United States has been very stable politically. There's no these ebbs and flows of inflation like you have in developing countries like Tanzania, where, I know the other day I heard that the government had, rigged the elections and inflation's skyrocketing again. So there's all these people in these countries that want to put their money into safe havens like the United States. And that's why the US is such an attractive way, a harbor to harbor people's money for asset protection, for capital preservation, but also then get that capital preservation can lead to good cash flow, which can then grow their nest egg and be out of reach of these developing countries' governments who may want to come and take their money from a dictatorship point of view. So I hope that explains it a little bit.
Oh, sure does. So many benefits to investing here. And the leverage side is probably the biggest one right there.
Right.
As far as leveraging that, non-recourse debt is huge in itself.
Yeah. So in talking about that, again, being an international investor can also have its downfalls. And that's like, when I first came here, people wouldn't lend to me or banks wouldn't lend to me.
Yeah.
So you have you're sort of hobbled a little bit with your being foreign. Oh, I can't. And the reason that the banks won't lend to you is because you are foreign and you have income from an international source. They can't verify it, blah, blah, blah. So some people buy all cash. International investors want to, again, place money in the United States as a safe haven. So they, if you look at places like LA and New York and Chicago and San Francisco, you have, Asian investors and international investors coming along and buying, properties all cash and causing, prices of real estate to skyrocket. And you have the same issue in Australia. I don't know, you have the same issue in Canada, particularly in Vancouver, where international buyers can just come and buy all cash and force the land values up. And I know certain governments like Australia and Canada have put, restrictions on international buyers. I know in Australia originally it was they had to be international buyers could only buy new construction. They couldn't buy existing construction. So I don't know if that's still the case, but I know Canada put in a tax on the Vancouver market for international investors, but that soon went away. So there's all these different ways to sort of ebb the inflation that comes when you have an influx of international investors buying all cash. And the reason is because they can't get leverage straight away. So what I do in my business is that I allow international investors, both international and domestic investors, to invest with me and my business partners. And we go out and get the debt because we're local to the market. We're local to America. We've got the credit. We've got all that stuff. And they can leverage us, and we co-partner and co-invest together, and we go off and buy large assets. So it's called syndication. And that's how I help international investors and domestic investors leverage into larger and larger deals to get more and more cash flow.
Yes.
So we overcome that leverage part of it. So yeah.
Yeah, excellent. Yeah, I definitely want to get to your syndication business as well. One of the things that I didn't want to touch on though is, and we talked about this before the show, is buying outside of the United States. I don't know how many people have ever asked you about that before, but let's say, for instance, buying something in, like, say, Colombia or somewhere in South America or anything else like that. Have you ever experienced or looked into doing anything like that?
I have, and back home in my own country, I've looked at stuff in Belize, I've looked at stuff in Canada. And again, with that international perspective and the fact that I've come here and created teams and done it here in the United States, it's such a large step for so many people to think like that. But for me now, I'm looking at other markets, and the world is my oyster. Like, I can invest anywhere. And it comes down to the same methodology. I equate it to if, an American's looking for, say they live in Los Angeles and they're looking for a low barrier entry market like, I don't know, Kansas City. And they have to, but the Kansas City can seem like a whole new country to them because of the geographical distance. But the same things apply when you go and build out a new market or you're looking at a new market here in the United States. And some of your listeners may be doing that, contacting brokers, contacting local lenders, contacting local legal advice, contacting property managers, contacting local GCs, creating a team on the ground in order for you to be successful as an out-of-state investor. The same adage applies when you go to Colombia or Australia or New Zealand or Canada. You need to invest and time and energy to fly to those areas, figure out the local market, figure out the trends, figure out your team, your boots on the ground. And if you surround yourself with the right type of people and the best in the business, if you can get your hands on them, then you're going to be successful in wherever market you invest in. That's both, if you're investing from LA to Kansas City or from LA to Mexico or LA to Australia or LA to Colombia. It's the same adage. It's just the mindset of, okay, well, if I'm going to go invest in those international markets, I'm going to fly there a couple of times because I'm going to have to, meet the people and get boots on the ground and touch and feel, the brick and mortar, and also get comfortable with the different neighborhoods. It's the same philosophy, same step-by-step guide that I do here myself when I go and look at a new market when I live in Los Angeles and I've got to fly to Atlanta or Texas or Miami or the other side of the country in New York. So the same step-by-step guide applies to those sort of areas as well.
Yes. And just you said, though, networking with the locals is a big deal. It's funny how when we first started exploring even Akron, Ohio, you would never have known this in anywhere on the public sources, but apparently the water here is crazy expensive, water bills of all things, right? So if a landlord is paying for water on a large, like say a 48-unit deal, it adds up really quickly. And I guess some time ago there was some water main break somewhere, and then the city decided to repair it and charge it back to the citizens in the form of new taxes. That's the reason why, like 50 years ago or something like that. And we're still playing that out today. But again, it's one of those nuances you would never know unless you have boots on the ground and you're there and you're local and you're engaged with what's going on locally. Yeah. Same thing happens.
Yeah, and I would say that, like Australia, like the United States, like Canada, like, other international countries, they're local groups, real estate centric groups, real estate investing clubs that would exist in every country around the world. Maybe it's not as like our Western countries. Like in Australia, we have RIA clubs. I know in Canada they have RIA clubs. I know in England they have RIA clubs. In a more of a developing country like Colombia, you may have to go to the Business Chamber of Commerce to understand who can they put you in contact with from local investors and developing groups in those areas. But it's, again, just understanding that information's at our fingertips. We just got to go find it and having the willpower to go do it. So if there's a will, there's a way, right?
That's right. And that's all of it right there, right? You really have to commit and attack that problem as opposed to just giving up so easily. People have done it. They do it all the time. just got to figure out how they did it. And just as you said, you got to take that first step and really get to know it. Yeah, that's right. So one of the things that they probably wanted to touch on too, probably should have touched on earlier, is how foreign investors are protected from, especially when it comes to the next economic slowdown. I think that the last one was pretty bad. The next one is estimated to be quite worse. What are your general thoughts around that? How do we protect those foreign investors when they do throw their money here in the States?
Well, you've got to understand two aspects of it, and I come across this issue a lot with international investors. And the first one is foreign currency risk, and it's how do you de-risk that? And that's a little bit of a hard game to de-risk from an international, particularly if you're buying real estate. Like you might invest, $1 million here 5 years ago, where the US dollar, and say the Australian dollar were in more parity, but now it's gone the other way. So you're now going to benefit that $1 million is now going to be worth more in Australia when you transfer it back. But the opposite could have happened, right? The Australian dollar could get stronger, and the American dollar could get weaker in a recession. So how do you protect that? Well, it's very hard to. Again, no one has a crystal ball, but on that risk front, I always advise my international investors that if you're going to come bring money to the United States, it needs to be here for a 5 to 10 year horizon. It's not just in and out within 1 year. You really want to make sure it's a nest egg for future generations, or So I've got some smaller investors who place $100,000 to $200,000 here, and the cash flow accrues in their bank accounts, and when they come here on holidays, they use that cash flow for a free holiday. Yeah. That's so there's different ways of reducing risk, but in terms of foreign currency, it's hard to dictate. But again, you want to make sure that you're leaving it there for the long-term future. In terms of a market correction. So again, foreign currency does have a little bit of, has very much tied into how markets change around the world. So as the US dollar gets stronger and the Australian dollar gets weaker, I'm using that as an example. It means the American economy is doing better. It doesn't mean the Australian economy is not doing well. It's in different rates. But if the American economy starts to go down and the US dollar starts to go down, typically other foreign currencies will also, particularly first world countries, will also start to be affected. But granular to say that's a nationwide downturn. But if you're say granular to say Texas, right, and something happens in Texas, like a cyclone or a natural disaster which causes economic heartache for that specific region, and you're invested in that region, but it doesn't affect the overall economy. Again, it's a way in which you have to look at different levels of risk and how you de-risk it. From a natural disaster to foreign currency risk to geopolitical risk. You have to understand all those different elements before investing in the United States, and make sure that you're comfortable with those elements, and making sure the team that you're working with have explained how you can set yourself up to make sure that you aren't exposed to too much risk in the event of a downturn. Now, specifically to a real estate deal, let's talk about, a 100-unit multifamily. Well, in general, in a downturn, whenever a downturn does come, as long as you have low leverage on your deal, as long as you're not trying to be the number one highest rented property in the market, as long as there's still good GDP growth, as long as population is growing in those markets, and it's affordable cost of living, there are ways in which you can reduce risk from a deal perspective. Making sure you have good property management on site, making sure you have the right team that is running the day-to-day, and who is that on-site manager. So it goes everything from the granular property level all the way up to the market level, and how you de-risk in the event of a downturn in the future. But again, no one has a crystal ball, and if we did, we would be in a different business. So
yeah, that's right. I mean, there's plenty of data out there, economic data, but part of it is, and that's what our job is as syndicators, is to try to select those markets that will de-risk as best as it can.
Right.
And I mean, buying for cash flow is one great way of doing just that. To buy for appreciation, like in some of these other countries, let alone markets here in the States, it's one way of really trying to reduce that.
Right. Trying to reduce it, I think, just to summarize for the listeners out there, your market, making sure in a market that has a strong population growth, it has multiple employers. So, a lot of people got burnt in 2008, 2009, when they're in these tiny little tertiary markets where it's only reliant upon one employer. Don't be going into markets in the United States where you have one employer. Make sure, as I said, there's a consistent population growth. Make sure that there's strong GDP, affordable cost of living, and make sure that you have moderate cap rates in order to get that cash flow and make sure that you can go in and buy a cash flowing asset. And typically I like to look at, if national interest rates are around 4.5% right now, you really want to be buying in cap rate markets where between 5.5 to 6.5, 7% cap rates. And if there's a delta of 100 to 200 basis points between interest rates and cap rates in those markets, then you're setting yourself up pretty good for having good cash flow. And then in a downturn, if that cash flow can ride you out through the downturn.
Yes. And that cap rate you're just referring to, that's B class, sounds like, right?
B class assets, but in general, you can look at B, C class assets. They're built in 1990s, 1980s, and 1970s. There are lower cap rates for class A properties in what I like to call secondary markets, and we can talk a little bit about what defines a primary, secondary, tertiary market in a little bit. But I'm definitely looking at moderate cap rates in secondary markets for class B and class C properties.
Well, that's good. Let's go into that then, because I do want to learn more about your syndication business. I'm sure the listeners want to know more about that as well. Maybe you can go ahead and explain that then, the secondary, tertiary markets.
So primary markets, let's think of, and I'm going to do from an international perspective because this is how I like to explain it. So your primary markets are the markets that you'd come to visit on holidays. New York, LA, San Francisco, Chicago, maybe Miami you could class as a primary market because they're holiday destinations and they have strong urban centers and they're highly valued. That the supply versus demand is off the chart, right? A lot of people want to live there because of the culture and the vibe and all that sort of stuff and the diversification. So people want to go there. So that's a primary market. And those primary markets are very similar to the Australian market or the Canadian market, where house prices, very high in $500,000 or $600,000 or higher just to get into that's like the lowest point on the scale. And there's not a lot of cash flow. You're really holding for appreciation. So you think of the Australian market like the LA market, except all of Australia is like the LA market, where the cheapest house you can buy in Australia would probably be $300,000 or $400,000, and it doesn't cash flow. So they're your primary markets. Secondary markets are the markets that are sort of transitioning. They got more of affordable cost of living. I spoke a little bit about. They've got good diversification of employment. They've got strong GDP growth, and they have, again, population is the big one. So stuff like Austin. Austin is nearly transitioning into what I would, depending on how you want to class it, but I would, from an international perspective, Austin, Texas is really on the map right now, but I'm talking more about like your Charlotte, North Carolinas, your San Antonio, Texases, your potentially you could think of Denver, Colorado, but again, that's nearly transitioning into a primary market. Those types of Kansas City, Kansas, those type of markets are what I'd like to call secondary markets, more affordable. People are moving there because it is more affordable and they have a strong diversification of employment. Your tertiary markets are those outlying markets that are maybe near secondary markets, but they are that one step down. So let's talk about, I'm trying to think of one right now, like Gainesville, Texas, down on the coast. Like I know people want to invest down there. The outer skirts of Dallas, Fort Worth could be tertiary markets. The outskirts of San Antonio. And I'm talking an hour's drive out of Dallas and you hit a market or hit a town, that would be a tertiary market. Like not classed as part of the MSA, which is, if for those people who don't know what an MSA is, it's the Metropolitan Statistical Area, but it's close enough where it could be somewhat affected. And, you may be hedging on that market to be absorbed part of the MSA in 10 years' time. So they're the real three levels: primary, secondary, and tertiary markets. I'm really in this from an investing point of view. I live in the primary markets, but I invest in the secondary markets, and I advise international investors to invest in secondary markets as well. Certain markets, again, like Austin, San Antonio, Dallas, Fort Worth, Charlotte, North Carolina, Greensboro, North Carolina. There's a couple of really, I think that's South Carolina. I can't remember which one it is. Nashville, Knoxville. There's all these sort of secondary markets that I'm very hot on. Jacksonville, Florida. Atlanta, Georgia, these are sort of markets that I'm talking about when it comes to being a secondary market and a good population growth, because the affordability is lower compared to those primary markets.
Yes.
I hope that explains it.
Oh yeah, sure does. So when you're going off and raising that money for those markets, what's your typical spiel? Like, do you typically find the deal first, or you have it set up as an investment fund, or how are you doing that these days?
Yeah, so if we enter into any new market, we spend a lot of time on the front end, getting in front of brokers, getting in front of the right people in the market to make sure we're seeing the right deals. And we'll spend maybe 6 to 12 months vetting out a market before we actually buy a deal. And that's because we're in a very hot market right now for multifamily. But once we've identified the market, we typically go and identify the suburb and the area in which we want to be in, and then we start underwriting deals. And we underwrite close to 60 to 100 deals in any one market, and we may offer on 10 of them, and we may get into best and final on 5 of them. We may close on 2 of them. So there's just a lot of volume that we're looking at. And when you look at a lot of volume, you can start getting very micro with your analysis on, the different types. If you're north of one freeway or south of a freeway, or if you're in this north of this suburb or south of this suburb. And that's the beauty of investing in America, is that, I hear these people say, the American real estate market, and I sort of scoff at it because there's 400 MSAs in the US, and within each MSA, there's a north, south, east, west. There's a suburb which is sketchy. There's a suburb there's not. There's a suburb which is in the path of progress. There's a suburb there's not. Within those suburbs, there's a good side of the tracks and the wrong side of the tracks, and then within even micro to that, there's a block by block trend. And so we make sure that we understand what those block by block trends are. And the way in which you do that is by underwriting a lot of deals in that specific market. You can get granular on what things are renting for price per square foot, for 1 bedrooms, 2 bedrooms, 3 bedrooms. You can get granular on where the path of progress is happening, where retailers going, where are big giant businesses like Hulu and Google and Amazon, where are they building their stuff? Because we try to follow those types of those businesses because they're smart, a lot smarter than what I am, and I just follow them to pick up the scraps. So I don't use that in my pitch, but we definitely look at big, like in San Antonio right now, which is one of the markets we're heavily involved in. Hulu is moving their back office there. We're really close to a big South Texas Medical Center there, and the USAA, which is a huge insurance company that is a big employer. So again, those 3 different major employers, and that's only just scratching the surface of what's going on in San Antonio. But I look at those sort of trends. I also look at path of progress. It's a huge thing, between if you've ever driven between San Antonio and Austin, that corridor, that I-35 is, I believe in 10 years' time, it's probably going to be one big metropolitan, like similar to Dallas, but it's a little bit further apart, but very much they have the same influence. In 4 lanes of highway each way, and being an Australian coming from to the big old America, you see those big highways and those big trucks, and you can just see the path of progress happening there. And so that's how I really pitch it to investors, that we're looking at all these different dynamics of individual markets and identifying the key metrics that are going to help, from that long-term vision, that long-term hold, 7 to 10 year hold. And we're going to be at another, we're going to be able to keep, rents are rising consistently around the country. We're definitely in where the American dream of owning your own home is becoming harder and harder to obtain. So a lot more people are renting these days, and that's going to force rents to keep growing and growing and growing, and hence why we're in the business of multifamily investing.
Yes. Good. Well, I'm sure that over your career and working in the business, many of these syndication deals, you've encountered some really tough deals along the way. So what was one of the more creative ways of getting a deal done?
Yeah, okay. So it wasn't in a syndication, we haven't had any too major hiccups. All syndication, the deals I've been involved in have gone quite well. It's actually been the earlier deals when I was doing it by myself. I flipped a few houses in Philadelphia back when I was living on the East Coast, and the one deal we had, it was a row house, and we tried to, as a structural engineer, I did up the drawings, and we put a 3rd story on this 2-story row house because the house next door was 3 stories, and we put a rooftop deck on it, blah blah blah. It ended up being a disaster. We had to fire the contractor. I became essentially the GC managing the subs, and it really boiled down to the fact that it wasn't that it was creative. It was just that there was not a lot of meat. I was buying it at such a low basis, and I was putting so much work into it that my cost on the outside, when it came to try and sell it, I was underwater. So, I didn't lose my shirt by any means, but it was definitely a lesson learnt, and I needed to have probably higher margins than what I was currently trying to operate at. So, definitely lesson learnt there.
Yeah, and you didn't lose anybody any money either, so that's good too.
No, I didn't. And as a syndicate, I had friends and family money in that deal, and I had to come out of my own pocket, and that's just a lesson learned. Like I was like, I promised you a return, I'm going to give it to you. Here it is. And I personally lost some money, but I made sure my investors were made whole, and they had a bit of a profit on the back end after 2 years of holding. So I did the right thing. And that's part of the game, right? You got to be willing to do the right thing, even if that means that you personally lose money. And that I'm willing to do that because that's the game we're in. And then so that gives me lessons learned, and make sure that I partner with the right GCs moving forward. Make sure there are bigger margins on the deals that we're doing, so the error factor can be eliminated. Make sure your underwriting is more institutional quality rather than being rudimentary about it. So really getting granular with analyzing repair costs, really getting granular with managing teams and managing people, because that at the end of the day is going to make or break your deals.
Yes, exactly. Even overdeveloping a certain, putting way too much money into the kitchens or the bathrooms where it's not really necessary for say a C-class property. Absolutely. So if you had the chance to start your career all over again, what would you do differently?
Oh, mate, I'm 32 years old. I've traveled around the world. I've had some incredible experiences. I don't think I'll do anything. No, and this is not. I'm not trying to be wanky or douchey about it. I just honestly really enjoyed my journey so far, and I look back and maybe I wish I got to financial freedom sooner. But it is what it is, and My mother recently passed away, and I sort of have regrets about living in America versus living in Australia and spending more time with her. But it's we all do this business in order to achieve financial freedom for a higher purpose. And my higher purpose is to, spend more time with my family and be financially free so I can travel around the world and keep experiencing new awesome stuff and cultures and all those sort of things and grow as a human. And I don't have any specific regrets besides maybe that one about my mum, but that's probably, I wouldn't redo anything. I've loved my journey so far, and it makes for a great story and a good yarn over a beer. So.
Yeah, that's right. Good. All right, let's. I'll tell you what. Then let's get into the mogul round and ask some questions about your mindset.
Sure.
All right. So you ready?
Let's do it.
All right. So, 3 are your most influential books and why?
Okay. Obviously, I've spoken about Robert Kiyosaki. I think it's for someone, and I'm going to talk. I'll give you 2. I'll give you 3, but I'll give you 2. One for the newbie investor. So Robert Kiyosaki. If you don't even know what the hell Casflow is, go pick up that book, and it will change your mind on just entrepreneurship and understanding employee versus business owner, between self-employed business owner and investor, and just understanding that quadrant. So that's for the newbie investor. For the more established investor who's looking to grow their business, and not just investor, but business owner, operator, someone who's looking to stand up, scale up, attract more investors, whatever that might be, pitch more effectively. I highly recommend a book called Key Person of Influence by Dan Priestley. He's actually an Australian guy. Very, very important about developing digital assets like podcasts, like thought leadership, about content, and constantly investing money into your content, which will help your business grow tenfold in the future. So that's more for you guys that are more established. And then another book I really, really love is obviously the 4-Hour Work Week, which establishes that really automating your business in a way that you're not the bottleneck in your business anymore, because a lot of people as entrepreneurs, they want to touch everything, right? They want to be, I need to control everything, and they forget to let go and get out of their own way. And I love when Tim Ferriss gets, he leaves his business behind. He's got case studies in there where he goes overseas and the business does, and he's away from it. And the business does 10 times better because he's not there stuffing it up. So about systemizing your business. So I really love those 3 books: Robert Kiyosaki's Rich Dad Poor Dad, Dan Priestley's Key Person of Influence, and the 4-Hour Work Week. Excellent.
Yes. No, Robert Kiyosaki's book was influential among many real estate investors.
Exactly. Yeah.
It's a great book.
Many. It is.
Yeah, great book. So what's your philosophy for life and success? Like what keeps you motivated?
I will start with saying, well, what started the motivation or what's the best quote that I've heard? And it was from my dad. And he said, a fool and their money are easily parted. And what he meant by that is like, don't be a fool when it comes to your money and educate yourself. Yeah. That's a quote. But in terms of what gets me going and the juices, I'm a mathematical brain. I'm a black-white brain. But I've really, really enjoyed the creativity of being an entrepreneur and creating your own business, creating your own income, creating this baby that is your business. And that's been really inspiring to me, and really rubbing shoulders with other entrepreneurs. That helps me give my juice flowing of a morning. I'm not a religious person, but I can see why people are. But I'm becoming more spiritual in the way that I'm, through meditation and all that sort of stuff, and being self-aware. But in terms of helping other people, I can see why, as we've been taught to help other people, it's just such a way of giving makes you feel good, right? And so creating a business where I can help other people achieve financial freedom has just been incredible. And the people that I've met over the past few years has just changed my life. And if you go back 10 years ago and say, hey, Reed, you're going to be in this position by the time you're 32, I would have punched in the face and said, no, you're wrong. But that's it's about the mindset. It's about the will and the want to get out of bed every morning, to keep grinding, to keep hustling, and to look at the glass half full, but also to remember the glass is refillable. So if you do stumble, if you do, struggle, we all struggle with, motivation, but that's why you listen to these podcasts. That's why I love getting on these shows and talking to these people like yourself who just make me feel good. I'm going to be in cloud 9 for the rest of the day after this chat. So it's awesome.
Yes. It's, and that's why I love doing these as well. I get to speak to other people just like you and really help the listeners know that anything can be done if you have the right mindset, especially in this business. Right. Other people have done it. You can do it too.
100%.
100%. That's right. All right, guys, if you want to follow up with Reed, you can reach him at reedgoosens.com or on Twitter, Facebook, and Instagram at Reed Goosens. So much value in this discussion. Thank you, Reed, for your time. I really, really appreciate it, man.
Hey, man, it's been an absolute pleasure. And as I said at the beginning of the show, you're killing it, you're crushing it, and you're providing some incredible learning platform for your listeners as well. So I wish you all the best moving forward as well.
Thank you. Thank you so much.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast. For more free podcasts, articles, videos, and resources, go to www.bulletproofcashflow.com.